Hey, Kate.
Hey, how are you, Tom?
Doing well.
Nice
I
sweater.
am I am rocking my fa la 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 ma holiday sweater.
That is fantastic
um,
and
he
incredibly
even
festive.
has a scarf that he wears with
Well,
tassels and whatnot.
that's a smart llama. It's cold outside. You got
Yeah,
to stay
exactly.
warm. Yeah.
So I'm nice and toasty right here today.
Yeah. Great.
And I think you have a holiday sweater on too. Yes.
I do, but mine tells a cautionary tale. Take it slow in the snow.
Oh, that's smart.
It's kind of my skiing motto as well. Um, you know, got to be careful out there.
You got to
For
stick to the
sure.
wedge.
Yeah,
Stay away from the
absolutely.
trees. That's right.
Yes, French fry, no pizza pie. French fry, no pizza pie. But yeah,
Yeah.
I wish it wasn't a synthetic fabric. It's not as breathable as I would like, but it's festive. So
Yeah.
the
Well, there's
sloth
so many
sticks
on the market
around.
now that they just make them, so people can order them on Amazon whenever they want.
Oh, there's so many. There's a plethora to look through, but all exciting and really fun stuff. And I love this time of year.
Yeah. Well,
You
let's see
know,
if we get a little snow. Speaking of skiing, it's we haven't seen any just yet. As I look out my window here in New Jersey, but crossing my fingers, we might get some soon.
January,
Yeah.
January, maybe a white Christmas, but probably January for sure. Yeah, and this time of year, I feel like the cadence of life picks up. There are holiday parties, just more activities going around and it's all fun stuff, but it's a lot.
It is a
And
lot.
I think one of the things that we're doing, certainly on our end, just preparing our client accounts to get ready for the new year, but also looking back on the old year is, this tax loss harvesting, right? Um, Reviewing our clients, capital gain situations and seeing where we can kind of strategically take losses in a lot of our client accounts. So that keeps us busy on the work front too.
Absolutely. 'Tis the season for tax loss harvesting. What a great
Yes.
topic. So I know you and I chatted about a lot of different things that we can talk about as the year comes to a close. I think a lot of the planning that our clients do, and then we talk to them about, we kind of try to tee that up right throughout the year so that we're ready to go. But one of the things that we can still take action on right now, to your point, especially when it comes to the portfolios that we're managing, is to take a look at what the opportunities are for lowering the tax bill for the year, right? So
Absolutely.
so today's conversation, we will focus on tax loss harvesting. We're going to talk about how that applies to specifically invested accounts. So as it applies to portfolios. So let's kick it off, Kate.
Great.
And there's actually a lot. So this may not be the most exciting topic, but I think there are a lot of different angles and nuances that we'll walk you through today, right? So that
And we'll
we
try to
can,
make it as exciting as possible. Come
well,
on.
of course,
It's
yeah. I mean,
exhilarating topic. Yeah.
whenever you hear the word tax, right, we don't want people's eyes to glaze over, but I think we have some good stuff to cover today.
And as you mentioned, right, so we want to talk about investment accounts, right? Essentially, capital assets are pretty much anything you own, right? And certain capital gain structures apply to different assets. But for today's purposes, let's focus on investment accounts. And remember, even within investment accounts, there are tax advantaged accounts and taxable brokerage accounts. In those those tax advantaged accounts, remember, any transactions that create either a capital gain or a loss aren't able to be recognized, right? You don't have to pay capital gains tax on gains that you're taking in your IRA account.
Right.
You also don't have to pay tax on any dividends or interest received in a tax advantaged account. And that's the beauty of a tax advantaged account. But when we're looking at taxable brokerage accounts, you do need to be mindful of when you are placing a sale in that account, what is the capital gain and or loss going to be in that account and what the tax implication might be.
So what kind of accounts? So if we're not talking about IRAs and 401ks and Roth IRAs and things like that, what kind of accounts are we focusing on today then?
Great question. So, right, these are brokerage accounts. So maybe it's a revocable trust account. Maybe it's a joint account. Maybe it's an individual account. So these are these, after-tax funds in this, non-qualified account.
Exactly. Okay.
I think even within, so when we're focusing on that taxable account, there are even two types of gains, right? There are all these little kind of maybe these let's go through some of these kind of some of these background facts, right? Before we get into the nitty gritty, maybe of tax loss harvesting.
Sure.
Right. Because even on the taxable, even within taxable accounts, you have two types of gains, right? You've got realized gains and you have unrealized gains.
My unrealized gains. This is one of those tax topics that's come up through Congress the last couple of years, right?
Oh yeah.
Congress trying to find different ways to raise revenue, and thankfully this did not get passed. But essentially, our unrealized gains are, we refer to them a lot as our paper gains, right?
Exactly.
A particular asset I bought hopefully happens to appreciate in value, right? And that is not a taxable event.
Correct. Yeah. Or to the contrary, sometimes when you see an asset that has declined in value, a loss has not been realized until it has been sold. So while it might decline in value and you continue to hold, you continue to have economic interest in that position, it's still an unrealized gain until you have sold the position. So that's kind of the classification between the two. So with the realized gain, you're then selling the position, and then the difference between essentially, what you paid for the security and what the proceeds were from the sale is going to be that capital gain or loss position.
And hopefully our clients know what their cost basis is, right?
Oh, it's a sensitive topic for some. Yes. It involves record keeping sometime.
But it's gotten a whole lot better. Especially over the last decade, right? With much more reporting and requirements of reporting. So when we're looking at account statements, that data these days is basically listed, right? It would be an odd circumstance if there was no basis recorded.
Absolutely, and I when I first started in the business, and I'm sure yourself, 20 years ago, the cost basis positions didn't always follow when the custodians didn't monitor it. Not that they didn't monitor it, they didn't maintain it for you. So it was really fully on the shoulders of investors to maintain that information. And, it's hard, it's complicated to keep the records, especially if you transfer an account and all that good stuff.
Right.
So
and from our standpoint, we know what we're paying for securities, right? So, it's been to your point about, what it used to look like. So, even back to the early 2000s, before they introduced the laws that started to track basis for different securities, right? We used to say, we would keep track of the cost basis. We would know what our capital gains and capital losses look like. But essentially, there was no cost basis police, if you will, right? Back then, at least.
Yes.
And it was really, and it still is up to, if you don't know your cost basis, it's really, it would show up as a zero, right? And if you paid more than zero for security, you want to make sure that gets recorded. So when it comes time to do your taxes, right, you're not overpaying taxes unnecessarily, right? And, so fast forward, they staged in reporting requirements, right, for different types of securities. And I forget what year. Do you remember what year that started?
So I think it was 2011, wasn't it?
I think that rings a bell. Yeah, it was the early 2010s.
Yeah, I think it was 2011 when they started on the equity side, and then mutual funds and the likes kind of followed.
That's right.
And honestly, if you don't know your basis, the IRS, you essentially that proceeds is fully taxable. The IRS wants you to assume zero if you don't have the records to substantiate what you paid for it. So which
could be pretty painful, right?
Very painful.
What that value is, for sure. And people make decisions all the time in terms of what kind of transactions they're making in portfolios, and certainly basis plays a role, right? You don't want that. You were saying the other day, right? We don't want the tax tail to wag the investment dog, right?
Absolutely.
And that makes a whole lot of sense, but you do want to be mindful of taxes. I was talking to somebody, I think it was last week or so, just about the topic of taxes. And, from our role as planners and investment advisors, right? Taxes kind of permeate almost every single discussion you have with clients, right? And in today's talk, we certainly want to be focusing on capital gains and capital losses, but that is part of portfolio decision making to an extent. And we'll talk through a couple of examples about that today. But we wanted to at least set the ground rules on. We're talking about taxable investment accounts, right? But there's other types of assets that are capital assets that you got to worry about your gains, right?
Absolutely. So even, a primary residence, but that's going to have different tax implications, right? You've got the Section 121, where you could have some of the gain potentially, wiped out, right? If you've lived in the residence for 2 of the last 5 years. So there are different rules that apply to different assets, for sure. The other thing, too, I wanted to mention, going back to cost basis even, there are different rules that apply there, too. So even where you've, acquired the asset, from if it's an inherited asset, that could have a different cost basis as well.
Good point. That's right. Yep.
Right. So there are a lot of different rules. And so I think it's always a good idea, too, to kind of review, the situation and the assets and almost, with your tax advisor, right, to kind of see where you are on an overall basis. I think it's always a good idea as well.
Yeah, I mean, we're about, I would say maybe a little over a month, maybe a month and a half away until 1099s get issued by custodians, right? Those are typically end of January. They've been kind of trending more like the beginning of February the last several years.
Exactly.
As they, reconcile accounts and make sure that their reporting and accounting is accurate. But you have a little bit of a window, just to be able to evaluate what the info on the 1099 looks like, right? And then, not every single account and every single year, but sometimes they have to, amend the 1099, right? They get some more information in from their reporting sources, and they have to make an update. And so you might get a corrected 1099. So just in terms of the tax planning part of this, right? You get a little bit of a runway, right, between when they issue that and when your tax return is due come mid-April.
Yeah, absolutely. And yeah, those corrected 1099s are always frustrating, but it's not the custodian's fault or anything. It's often exactly what you said. It's those entities that are reporting their income and kind of how things are broken down for the year. So, but can certainly be frustrating. And the other thing I want to bring up too is, kind of long-term versus short-term gains, I think is another clarification that we really need to kind of fine tune. Right. Because it's not just what you're holding or what type of asset, but it's also how long you've held the asset.
Well, how long is long? What defines long-term?
So long-term is actually 1 year plus a day. And that plus a day is key, right? Because let's say I were to buy an asset on January 1st, 2022, and I sold it on 1/1/23 because I was like, it was a year. Nope, that's technically short term. So short term is 1 year or less. And there are actually different gains rates that will apply to both. And we'll kind of go into that, I think, maybe a little bit later in our discussion.
We have a good a slide that we can show on some of those details.
Yeah, so let's get into that later. Maybe we should focus on, why tax loss harvest. And I know we've kind of hit on some of these topics briefly, but maybe we go into a little bit more detail and give a good example.
As we pull up the slide, you and I were chatting about whenever you're focusing on a particular planning technique, right? And in this case, we're talking about taxes, how it might apply to capital assets and things like that. So the opportunity here is to be mindful of essentially your after-tax return, right? So because we're focusing on non-retirement accounts, these types of accounts, there is reporting every single year on what happens inside the account, right? And there's a tax impact there. And that would include everything from how much dividends you earned, right? How much interest you earned. If you did realize capital gains, how much capital gain did you realize? And you got to pay taxes on all those things, right? So to the extent that if we know that we're in a high tax bracket, right, we can include municipal bonds, for example, in fixed income, as opposed to, let's say, corporate bonds, or not using corporate bonds 100%, but we'll mix in some muni bonds because it makes sense from a tax standpoint. And certainly if the investment part makes sense as well, right? So the why is really just like anything else that we're talking to clients about. It's how do we optimize what we're doing, right? And recognizing that there's opportunities if you own something in the account that didn't work out, right? And that can happen, right? Certainly, there's some things that may underperform, and so from a keeping track, I think of how your investments are performing, right? There are opportunities for us to essentially, I like to call it like money in the bank, right?
Yeah.
If you book a capital loss, you can do something with that, right? And what we're going to talk about on the slide here is essentially, for the most part, when we do capital loss harvesting, we are reinvesting the proceeds. We're not just leaving in cash, right? So, if client needs cash flow, that's another story. But for the most part, I think for our discussion today is we're looking to book a loss for tax purposes, but remain invested, right?
Absolutely.
So that's why I like to call it like money in the bank. That loss is money in the bank that you can use to offset other gains. So let's chat about our example.
Yeah, and I think that's a great point too, because as we mentioned before, when you're selling a security, you're realizing the loss. So you want to make sure that you're also identifying, replacement securities that are a good fit, that are going to help you recuperate some of that loss that you've incurred. And capital gains, they aren't a terrible thing, right? You've made money, but we want to do things as tax efficiently as possible and being mindful of that after-tax return. So let's give two examples of my buddy Jack Frost. Had to. I couldn't resist.
Absolutely. Let's do it.
All right. So Jack Frost, hey, 2023, it was a better year than 2022 in the markets. So Jack Frost, he took some gains. So Jack Frost took short-term gains of 36,000 and he took short-term losses of 10,000. So he has a net short-term gain of 26,000. He took long-term gains of 12,000, long-term losses of 18,000, and net long-term. So he nets out long-term $6,000 loss. So then when we net them both together, it's a 20,000 net short-term gain. Now, we'll go into kind of maybe how we net out, maybe on another slide as well. But what you always want to do is, you net out your short-term gains and losses first, and then you net out your long-term gains and losses, and then you net the short-term plus the long-term equals your actual position. And now, mind you, too, when you're looking at your overall picture, you might have assets that are at different custodians, right? They might be held in one custodian than another. So you really need to aggregate your picture.
Great point. Absolutely. Yeah, that's not uncommon, right? To have several accounts at different institutions.
Absolutely. And then, as we were mentioning before, what if you sold a vacation property? So being mindful of making sure that you're considering your full tax pictures, especially when you're, at this time of year, to see where you really are. So going back to our Jack Frost example number one, where we have 20,000 in net short-term gains. Now, mind you, we mentioned you have short-term, right, which is a year or less, and then long-term, which is a year plus a day or more. When there's short-term gains, you're actually taxed at your ordinary income rate. We'll get into some of the long-term capital gains rates in a little bit, but the short-term gains are taxed at a higher rate because for most people, that's going to be a higher clip. So let's say Jack Frost is earning $260,000. So Mr. and Mrs. Jack Frost are earning $260,000. They're taxed at 24%. Since they're earning over $250,000, they get hit with that net investment income tax of 3.8% since they're over $250,000. So I know. So their approximate tax bill would be about, $5,560. So while you have these short-term gains, and that feels really good when you're selling things in the portfolio, well, how are you going to pay for this? Now this has to come out of the assets. So, is there a better way? Right?
I hope so.
Hope so. Poor Jack Frost.
This is pretty painful. This example.
So exactly. So Jack Frost, in our example number two, let's say Mr. and Mrs. Jack Frost take a look at, their overall picture and say, oh my gosh, we have these 20,000 in net short-term gains. What are we going to do about it? Well, let's say they find that they have 23,000 in additional short-term losses that they can realize and harvest. So here, again, kind of identifying that replacement security. So let's say they have this $23,000 loss in ABC stock, and they have found that XYZ is a replacement security that fits into their overall asset allocation and also is, has good growth prospects similar to, what they felt with ABC stock. So now they realize and harvest this 23,000 short-term loss. So their net short-term gain is only 3,000. Long-term loss is still a loss of 6,000. So they net this 3,000 short-term loss. So in this scenario, there's also this added benefit that we need to mention that you can offset only 3,000 in realized losses against your ordinary income. So that's a great benefit. Any more than that 3,000, you can carry forward to future years. But if you net everything out and you have a $3,000 loss, you can use that against your earned income.
So this is a big swing here from the top of the page to the example on the bottom here. We were facing a tax bill of close to $6,000 before we actually look to see what other opportunities are available before the end of the year. And again, this happened to be a short-term loss. So I think it just highlights that for the most part, I think most folks are trying to own securities more than a year and a day, right, before they transact. So they do get that more favorable tax capital gain rate, right?
Yes.
But how life works is sometimes you need to pivot from an investment, right? Maybe you need some more cash flow, right? And that's why you sold something less than a year, right? And maybe you identified something else, or maybe you needed the cash for, a different type of investment. But that's painful, right? That short-term tax at ordinary rates, that's just like adding this on top of your salary, right?
Yeah. And again, we're trying to be mindful of that after-tax return, right? It's not just about what you make, but it's about what you keep at the end of the day.
Yeah. And Jack apparently found, a loser, right? He had a loser, maybe he bought something at the peak, right? Maybe earlier this summer. And it just really fell like a rock during the third quarter, for example. He said, "Hey, let's use this to lower the tax bill, and then find something else to invest in."
Right, absolutely. And wanting to make sure that you're being mindful of your overall asset allocation, because if you take a loss, you want to make sure that you're positioning yourself to, recuperate that loss as well, right? And that's where that replacement comes in.
Yeah, good point.
For sure. And then I guess, do we want to walk through maybe how we net out figures? Like I know we kind of briefly went through that.
Yeah, because you just only briefly touched on that. And it's actually something that came up recently. I was talking to somebody in the office, a couple of weeks ago about the process, right? And it's not something that people focus on every day, but there is there's a process that you need to follow, right? Based on short versus long. And then the important piece is at the end, you want to get to a net number, right? That net number that you mentioned before. So, all right. So let's take a look at the example we have here.
And it's so funny because it almost sounds like you're misspeaking when you say it. It's like net.
Yeah. So I think that's the bottom line is what does it look like? What's the net based on what happened in my account this year, right?
Exactly. So, and again, you want to review all your different assets, right? And compile all of your short-term gains, all of your short-term losses, net that out, get that net short-term figure. And then you want to net out all your long-term gains, all your net-term losses, net out that number. And then net, that's what your capital, that's what your picture is there. So in this example,
so I'm actually allowed to use my net long-term loss in this example to offset my net short-term gain. Exactly.
And so you can ultimately net it out, but then ultimately when you get that number, you still need to be mindful of kind of where that gain originated, right? So if we have long-term gains and short-term gains, those are going to be taxed at different rates. Right. But in this example where we have this long-term loss, you can still use that to help offset your short-term gains.
From a rate standpoint, obviously short-term is more painful and you want to try to avoid that as much as you can, right? All things being equal. But I'd say from if we just do a 30,000 foot view level of a snapshot of where rates are today, in 2023, generally speaking, they're lower, right? The Tax Cuts and Jobs Act lowered the marginal rates on ordinary income, and from a capital gains standpoint, I think most of the time, you see folks that are in the 15% rate, which is pretty favorable. But that's the 15% is not the only long-term capital gains rate.
I knew you were going to ask. Tom.
Do you have a slide for this? Yes, you do. Look at that.
How'd you know? So here we go. So now these are for 2023. So don't write this down and use this for 2024 because it's going to change, but it changes slightly. So we figured this is still valid. And especially at this time of year, this is where you'd be at for, reviewing your 2023 situation. So we still felt like this was valid, but make sure you review your 2024 numbers. There are 3 long-term capital gains. And now remember, this is long-term, right? So year plus a day. So you've got 0%, 15%, and 20%. And I know some of you are saying, whoa, 0%, 0%. So 0%. So if you're married filing jointly and your taxable income is less than $89,250, you don't pay taxes on capital gains. So, that could be an opportunity for some people, maybe with lower income, to maybe even harvest gains. So
I think it's something that a lot of people don't focus on, right? I think everybody always thinks, I have to pay tax on my capital gains no matter what, right? But there actually is this 0% rate up to a certain level.
Exactly. So this is almost like, kind of who should consider tax loss harvesting? Well, I think this is almost like a really good place to start sometimes, right? And kind of review your tax situation. What might the tax law, implication be? Because again, you could end up in a scenario where maybe it makes more sense to harvest gains instead of taking losses to help offset those gains to reduce a tax bill. Because if there isn't going to be a tax bill, it doesn't matter.
Yeah, it's like trading in your IRA, right?
Right, exactly.
There's some maybe there's a transaction cost, but at least there's no gain.
Exactly. Yep. So, I think most folks though really fall into this kind of 15% bracket, right? So kind of married filing jointly between this $89,250 and $553. And then this 20% bracket would be over that 553. And also remember, I kind of glazed over it before, but there's this net investment income tax as well. So if you're earning over $250,000 married filing jointly, there's this additional 3.8% tax on top of it. And then single, obviously these are the break evens there as well. So that's something to keep in mind. Yeah.
Well, yeah. You can that 3.8 can apply to the 15% bracket, right, as well, because the threshold. So there's a lot of different numbers to keep track of, unfortunately, right? But I think between our role, right, as advisors, and then our clients, tax advisors, certainly, there's a team of people in place to kind of keep track of what particular bucket you might fall into, right? And not to underestimate what the tax impact would be. So, the fact that this net investment income tax of 3.8% exists is something that, you want to make sure you're paying attention to, right? Because if you think you're paying 15%, but it's really 18.8, right? Close to 19% on capital gains.
Yeah, it makes a difference.
That's meaningful. But then there's all these little nuances in terms of where the net investment income tax comes into play, right? Which is, we have it on the screen here. There's thresholds, right? Depending on if you're filing taxes married, filing jointly, 250 is the threshold. And if you're single, it's 200. Those haven't changed, by the way, right?
No, yeah.
This has been on the books so the net investment income tax, if I recall correctly, this is one of the tax revenue centers to help pay for the Affordable Care Act, right? So
it is, yeah.
It's, it's another tax layer that got added to the Internal Revenue Code, but they haven't, like many other things, they haven't adjusted this for inflation. So we're still at 250 for married filing jointly. And I'll, just real quick, right? Where does it apply? It's the lesser of, right? The difference between your modified adjusted gross income above that 250 level, right? If we're just focusing on married filing jointly, or my net investment income for the year, right? So if I exceed the 250 by, let's say, $50,000, but my net investment income is only 25,000, then I would pay the 3.8 on the 25, not the 50, right? So that's the thing. It gets a little confusing or so, and we don't need to go, I think, down a rabbit hole here, but to the extent that that 3.8 applies, whether I'm in the 15 or 20% rate, is something that we can certainly at least bring to our clients' attention and their tax advisors, right? So that we're all on the same page. So there's no.
I think it's a great.
At the end of the day, it's really
out.
about like no surprises, especially when it comes to taxes.
Tax surprises are everyone's least favorite surprises. I think that's the consensus. And also, just a heads up, right? Like if you have an estate account or a trust account, those brackets are much lower. So you get to those higher capital gains brackets much quicker, right? So being very sensitive in those trust accounts because you're going to get to those higher capital gains brackets much, much quicker.
At only $14,000 and change. I'm at the highest.
You're there. So for sure, something to keep an eye on.
Do you want to jump into the wash sale piece of this?
Sure. And maybe why don't we, just starting off with maybe a good example, I guess because everyone's probably listening to this is saying, well, okay, great. I'll just sell something. I'm going to sell ABC stock. I'm going to take my loss. I'm going to get this fantastic tax benefit. I'm going to buy it back the next day. Why wouldn't I do that? Sounds like a great idea.
Yeah. Easy
peasy. But the IRS essentially doesn't want you to take a loss and have retained your economic interest in that position.
What does that mean?
That would make it too easy. So meaning that, you need to have actually realized the loss and not buy it right back.
So experience the ride that comes with investing, right? Which could be, on the way up, which is where we want it to be, but it also could be on the way down, right? So they want you to remain invested in an experience, right? Be economically vested in that investment as opposed to quickly trading in and out.
Exactly. So, you can't just retain your interest in that position and get the benefit. It's not fair. It doesn't make sense. Exactly. So the wash sale is, when taxpayers sell a security at a loss. This does not apply to gains, mind you, right? IRS wants you to take as many gains as you want and pay tax on it.
Yeah,
so maybe that's a good thing to highlight, right? So this is when you're taking a loss. So when you're realizing a loss, you're not able to buy the security back, well, 30 days before or 30 days after. So it's actually this total 61-day window. So just as this graphic shows, so if you buy a security 30 days before, you have to wait 30 days until the sale to be able to allow that loss. Then even after the sale, you have to wait another 30 days before you buy it back.
It's a big window.
So it's a 61-day window. It is a big window. And what happens is, let's say I buy ABC stock and I wait my year and a day, and then I sell it for a loss, but then the stock gets hit and I can't help myself. I've got to buy it back 10 days later. That loss then becomes disallowed. So that's where there's wash
So I can't use it at that point?
Actually, what happens with those disallowed losses, ultimately they get added back on just the disallowed loss portion gets added back onto the replacement securities that you bought. So in that example where I buy ABC stock, sell it a year later and a day, and then I can't wait and I buy it back after taking the loss 15 days later, that disallowed loss portion on ABC stock is now added to the cost basis of my replacement shares. So when I ultimately go, and hopefully I learned my lesson and I wait 30 days after that, that transaction before I sell it again, ultimately you're able to take the loss, but especially where clients are trying to realize a loss before year end, this becomes a very sensitive topic because the wash sale rule doesn't just apply to a calendar year, it is this 61-day period. So you don't want to have a loss disallowed if I'm trying to take it for 2023.
Yeah, that's a good point. I think we can think of the calendar rolling over soon to 2024, right? It's a brand new tax year, clean slate. I can just go buy back whatever I want, right? You can't do that, right?
No, it feels all fresh. Don't fall into that trap. That 61-day window is that 61-day window, irrespective of, what calendar year it is. So really being mindful.
We're recording this on the 15th of December. So in your example, we'd have to wait to go purchase that particular security back again until January 16th.
Exactly. Yep. Not doing the math, but yes, definitely. So being very careful with that. And again, the one thing you need to watch out for, and this is where it gets a little bit more complicated, but you really need to not only coordinate, if you're married filing jointly, you want to make sure you're coordinating with your spouse. And you want to make sure that, this doesn't just apply to if you have accounts at different custodians. This applies across the board. So you need to coordinate with your spouse, because if I'm selling it in, the joint account, my spouse can't be buying it in their IRA account. So again, making sure that you're not maintaining that economic interest in the position.
That's a good point. I think that is something that could be easily overlooked, right?
Yeah.
It's not uncommon that, clients have, 4, 5, 6, 7 different investment accounts, right?
Sure.
Because people create these buckets, right? You have, to your point, a joint account, right? You may even have started with your own individual accounts. Those may still exist. That's 3 right there. Then you each may have an IRA and a Roth IRA, right? So it's, next thing you know, you have 6, 7 accounts. So I think when it comes to planning, it's important to pull up all the statements, right? Review what you own, right? If I'm going to sell something for a loss in this account, where else do I own that particular security?
Definitely. And it gets complicated. And depending on, how frequently you're trading, you really need to be mindful of the time frame, right? And that holding period for the securities.
So in terms of strategy, so we're, the example we're using is something's held at a loss and you want to sell it to book that loss, right? And then, for the most part, what you would do is you would identify something that you would reinvest in right away. So again, from a tax point of view, you're booking the loss, but you want to remain invested, right? So you're investing in something else. But back to this wash sale rule and the whole 30 days before and after. That's one way to do it, right? Just blow out the position altogether, try to book that loss, and then maybe if you really want to be back in that particular security after 31 days or so, you can go buy it back. But the other type of way to think about this, right, is to say, I do really like this security, right? It fits my investment strategy, right? What's the other type of way to think about this?
Sure.
And the complicating factor about where we are right now.
Exactly what I was going to say, right? So here we are at December 15th. So a lot of times, earlier in the calendar year with some of our client accounts, because as you're saying, right, we're putting our investment hat on as well as our tax planning hat. Mm-hmm. So making sure that we're marrying the two. So, and as you said, don't let the tax tail wag the dog, right? Because we want to make sure that we're thinking about this from, a smart investment standpoint too. So if there's a security that we want to maintain, if you have time, what you can do is buy ahead. So essentially creating another tax lot, wait 30 days plus the sale date, right? So total of 31 days, sell the security and pick the higher tax lot. So meaning you're then realizing the loss, but maintaining your ownership in that company. So, and that's another thing to point out too, is, when you're purchasing securities, sometimes you have multiple tax lots, and sometimes you can even select which tax lot you want to use to sell. So if you're not exiting the full position.
Yeah, you want to maintain control over, not only do I want to either buy a security or sell a security, but to your point, right? If I've bought it at different points over the years, or maybe in a particular year, depending on how it was trading at that particular time, right? That particular lot could be held at a gain or a loss.
Exactly. So being mindful of that too. And one other little caveat I want to throw out too, if you're selling the entire security, so let's say I bought ABC stock.
Yeah.
And I waited 15 days and the stock has some terrible news. It goes down and I just want out. but it's only 15 days. You can actually, as long as you're selling your entire position, you can still take the loss, even though it's only been 15 days, as long as you don't buy it back the following 30 days. So meaning as long as you're exiting the full position and not buying it back, you can still take the loss.
Yep,
not to overcomplicate things.
I was going to say,
was that too much?
Well, no,
just
not
too
much.
Okay.
But I think it just highlights the nuances involved here, right?
Good point. Yeah,
and
exactly.
The rules involved. And by the way, it's also how this gets reported, right? It's all this stuff is automatically reported now on your 1099, right? So come at the end of next January, beginning of February, all the transactions that have happened inside these taxable accounts will be recorded on that 1099, right? A copy goes to the IRS and a copy goes to you, and you can use that as you prepare your tax return. So it's everything from that point you just made, right, to even the piece about the disallowed wash sale rule, right? And just making sure that the custodian is actually recording the fact that you have to add the disallowed loss to the basis of the new security, right? There's just a whole lot of things to keep track of.
And not to double down on my last comment, but here we go. The other thing too is, when you are doing this wash sale, we're talking about picking up replacement securities. You have to be mindful that, the wash sale really follows QSIPs, right? So you have to be mindful about, what you're replacing the security with. It can't obviously be the same security. You also, this rule applies to bonds. It applies to options. So you really need to be mindful of what you're doing. And, the rule is that it can't be substantially identical, right? So being mindful of that replacement security and making sure that it follows the rules, because there are a lot of caveats and hiccups.
That's a good point. Yeah. I think sometimes people might, you might struggle. Maybe you're not prepared for what you would replace it with, right? If you want to maintain exposure to a certain area of the market, right?
Right. Yeah.
How do you do that, right? Or can you do it? And to your point, you can't do something that's basically the same. So, in a classic S&P 500 ETF example, right? If I happen to hold a particular S&P 500 at a loss and I want to replace it with another S&P 500 ETF,
that's a no-no.
I can't do that.
That's a no-no.
But there are ways to maintain exposure to that segment of the market, right? There's other large cap passive investments, right, that track, generally the space of the S&P 500.
Exactly. So maybe instead of the S&P, maybe you want to look into a Russell 1000. And again, you just got to kind of get past this 30-day period, and then you could sell the replacement security and, enter back into the S&P. So you want to be maybe considerate of the space, but again, can't be substantially identical and all that.
Yeah. And there's, and I guess maybe the good thing today is the number of different securities that are available to purchase, right? If you just think about ETFs alone, exchange traded funds, there's an ETF for any part of the market, any sector, any theme, any factor. So replacement security selection now should be easier than it ever has been, right? But it's important just to make sure that you're not violating the rule. And even in the individual stock space, right?
Sure.
And we're not here giving any investment advice, but just to have a nice clean example. Right. It would be, for example, if I held Pepsi at a loss, I could sell that and I can buy shares of Coke. Right. I can maintain my exposure to that part of the market. Right. And those are two different companies that are they're operating in the same space. Right. So again,
that's a great example.
Not an endorsement for one company or the other, but it's a way to kind of think about if I want to book this loss, but maintain my investment in a particular area. That could work.
Great point. I hope we haven't, there's a lot of little caveats and hiccups here and there for sure. So maybe we want to just kind of do like a quick sum up of, what we've discussed and maybe.
Yeah. think that makes sense.
So I think one thing that I've noticed some clients get tripped up on, and it's an easy mistake, is kind of starting where we started, looking at is this account a taxable account? Is it a taxable brokerage account, or is it a tax advantaged account where I don't need to worry about capital gains and losses? And taking a capital loss in a tax advantaged account isn't going to serve you. That doesn't carry over to that a taxable account.
Right.
So really being mindful of that. I see, sometimes that can be a confusing point for some folks. The other thing I really want to mention too is it's always a good idea to see what your previous loss carry forwards are, right? I don't think we've touched on this yet.
No, we haven't. That's a great point. Right. And even it's actually a great point right now because of what happened in 2022, right?
Sure, exactly. Yeah, so 2022 is a terrible year. Some folks suffered investment losses. It's possible because what happens, I know we gave that example where Jack Frost has that 3,000, short-term loss, but let's say that short-term loss was a $10,000 short-term loss. He was able to write off, 3,000 in short-term loss in that tax filing year and then carry that additional 7,000 for future tax years.
Right.
So if you have loss carry forwards from previous tax years, reviewing what that is, because you might not need to harvest losses. And again, always putting on that investment hat as well as that tax hat.
Yeah. And it's a way to kind of think about spanning, multiple investment years from a tax standpoint, right? So to your point about whatever might have been harvested during 2022, it was an opportunity, right, to book some losses based on what was happening, and again, put that money in the bank for future use. So if you fast forward to this year, obviously it's been a nice, welcome turnaround in a lot of different areas of the market, right? So to the extent that there are some of those losses to carry forward, you want to use them, right? So if there are some gains in the portfolio and you've been thinking about repositioning, right? Strategy may have changed a little bit. You want to pivot to a different area or so. And you're going to realize a gain. That could be fine if I have some loss carry forwards to take care of that, right? So again, it's really about being as tax efficient as possible when it comes to managing assets that are in these taxable accounts. And you're going to have years, hopefully, right, where the market continues to behave, if you will, right? It continues to move in the upward direction for multiple years, in which case the opportunity to tax loss harvesting won't always be there. So I think it kind of highlights the opportunistic nature of this particular topic, right? And just at least paying attention to to spotting the opportunities and just knowing some of these nuanced rules that come into play for sure.
Point. That's a great point for sure. And I think, the other little thing to mention too is, sometimes folks own mutual funds, and, even in a down year, what can happen is even though you have a paper loss on the investment, if the mutual fund received, sale orders, you could even get hit even in a down year with capital gains distributions from that mutual fund. So I think also, again, making sure you're really aggregating, maybe you can get a projection of what those mutual fund capital gains distributions might be for the year to help you put together that full picture.
Yeah, that's a really good point. I think it highlights the difference between the tax efficiencies or inefficiencies, if you will, of the mutual fund format versus an exchange traded fund, right? And if you're not paying attention, those distributions and like right now, a lot of those distributions are happening, right? They start, the big distributions start typically November into December or so. And, if that particular investment hasn't done well for the year, and next thing you know, you're getting hit with a capital gain distribution. It's something that, can be surprising if you don't know what to look for. But if you know what funds you own, right? If you look at the ticker symbol for that particular fund, you can Google it very easily. The fund companies have a capital gain distribution link for the most part on their homepage, especially when you get towards the fourth quarter of the year, and you can kind of keep track of what that might be. So depending on how many shares you own and what kind of level of distribution they want to make, right? Could be a big distribution year depending on how much activity happened inside that fund. And I think the other thing, Kate, is it's a little bit of like a warning of if you're going to buy into a mutual fund towards the latter part of the year, right? You may be an investor for, let's say, a month, but because you're an investor as of the record date of the capital gain distribution, even if you weren't invested since January, you'd be on the hook for that capital gain distribution and the tax hit that comes along with it, even if you basically just jumped in, right, with both feet.
It's harder to control your destiny, with
so it's something to be
sure.
careful in terms of just the timing aspect, right? But there's other ways to gain exposure to, whatever part of the market that mutual fund might be investing in, if you want to avoid that kind of a tax element that might pop up.
Sure. And I think the other key point too is, of course, making sure you're considering things from an investment standpoint, also from that tax planning standpoint, right? When you are realizing a loss, you are taking that hit. So being mindful that you want to, evaluate the investments that you're replacing, make sure that they're good fits, make sure that they're fitting in from an overall asset allocation standpoint, so that you're able to recoup and, hopefully, and maybe turn that loss into a gain, down the road, right?
That's the goal. Yeah, absolutely.
With that replacement security. So
yeah, and we'll see what the future holds in terms of, changes to the rates themselves. I would just make a comment on that just to say, I've had discussions with clients about the concept of, in an environment where, let's say, there's a lack of any capital losses to harvest, right? You own a lot of things in your taxable accounts because you've owned them for a long period of time at a pretty good unrealized gain, right?
And that's a good problem.
If you were to sell something, you would.
It's a good problem,
right?
But a problem.
That's why we invest. Absolutely.
Yeah.
But to the extent that let's say you're living off the portfolio now, you need some cash flow, right? You gotta generate some amount of cash in order to, make sure that your cash flow needs are met. That typically means that you're going to be, making some trades in the portfolio and realizing some capital gains. And I would say, if you just, again, take that 30,000 foot view level, number one, the rates right now are not that bad. They're fairly low. Don't forget about the 0% capital gains bracket, right? Take advantage of that if you fall into that particular bucket. But the 15% bracket is still something that is, it's below where our ordinary rates are right now. And, you can think about having for lack of a better phrase, like a budget for capital gains harvesting, right? So not just losses that we wanted to focus on today, but, if you happen to be in this environment where, you have a lot of unrealized gains, it's not the end of the world to realize some gains, as long as you plan for what that tax element is going to be, right? What's my tax liability if I were to realize, X amount of capital gains this year? What if I do a similar amount next year? What other things are happening in my life that would impact whether I'm in the 15% rate or the 20, right? Am I going to get hit with that 3.8% surtax? So I think this kind of highlights, again, just kind of thinking through and planning, what does it look like for me this year? What do the next couple of years look like? Should I be budgeting for some general amount of capital gains? That's going to be different for every client, right? That discussion is going to be very different depending on what you own and your level of need from the portfolio. But if you're in the boat where you got to live off the portfolio, right? Which is what people want to work so they can retire, so they can use the resources to do the things that they want to do to have a happy life. And
that's a great point.
We want our clients to have happy lives, and we don't want the tax bill, right, to upset the apple cart. So I think if you can at least have a plan in place, know what your potential gains look like for the year, then there's not going to be any surprises, right? And what the rates look like now, and we're going to have an election next year, right? We'll see what might happen to ordinary income brackets and also long-term capital gain rates as well.
Yeah, no, that's a great point for sure. Well, neat. Well, I think we've probably exhausted everyone with our tax loss harvesting, caveats and examples and all that good stuff. But I think we're still under an hour. Are we? Okay. All right.
So hopefully,
That's good.
the topic and the time wasn't too bad. But so this will be our final podcast for 2023. It's only our second, but we wanted to get started, and we didn't want to wait till the new year, right? So
we're too excited.
So I'm happy that we've started already. Hopefully, the content that we're covering so far is helpful. It's meaningful, and we're excited about kicking off January and 2024 as a whole. We plan on having this on basically a monthly basis. And January provides a great opportunity for us to open the door to new planning for the year ahead. So we're gonna put our heads together in terms of some good topics to talk about. We'll bring in a guest, right? We'll have a guest in January.
That'll be exciting.
And hopefully have a good kickoff to the new year.
Well, great. Well, this has been fun. Yeah, I hope this was helpful to everyone, and wishing everyone good health and happiness for the holiday season and the coming year, and looking forward to an exciting 2024.
Absolutely. Yeah, no matter what you celebrate, we hope you have a joyous holiday season and a very, very happy new year.
And hoping everything goes according to plan.
Well said. Well said.
All right. Well, we'll see you soon.
Okay.
Okay. Be well.